September 15, 2008, Lehman Brothers files for bankruptcy. Within hours, the global financial system is on the verge of complete collapse. You've heard the story 1,000 times. Greedy bankers, subprime mortgages, a housing bubble that popped. But here's what nobody tells you. The housing crisis didn't cause the financial crisis. I know that sounds crazy. Every documentary, every explanation, every politician pointed to the housing market. But when you actually trace the flow of money, when you follow the mechanics of what broke, you discover something completely different. The housing crisis was a spark. What actually exploded was a $60 trillion machine that almost nobody understood, including the people running it. This isn't a story about what you think happened. This is a forensic analysis of what actually happened. We're going to follow the money, examine the mechanisms, and reconstruct the collapse minute by minute. By the end of this video, you'll understand why 2008 happened. Not the simplified version. The actual mechanical breakdown of the global financial system. Let's start with what everyone got wrong. Here's the story you've been told. In the early 2000s, banks started giving mortgages to people who couldn't afford them. These were called subprime mortgages. People with bad credit, no down payment, no proof of income, they were all getting loans. Housing prices kept rising. Everyone assumed they'd keep rising forever. So banks kept lending. People kept buying. Then in 2006, housing prices started to fall. People who couldn't afford their mortgages started defaulting. Banks that held those mortgages started losing money. By 2008, so many people had defaulted that major banks collapsed. Lehman Brothers went bankrupt. AIG needed a bailout. The whole system nearly came down. That's the story, and it's not wrong exactly, it's just incomplete. Because here's the problem with that narrative. The numbers don't add up. The total losses from subprime mortgages were around $250 billion. That's a lot of money. But the global financial system lost over $10 trillion in value in 2008. How does a $250 billion problem create a $10 trillion crisis? The answer, it doesn't. Unless something else is happening. Something bigger. Something hidden in the architecture of the financial system itself. Let me show you what actually broke. To understand what really happened, you need to understand how mortgages actually worked in 2008. When you get a mortgage from a bank, you might think the bank holds that loan on its books, waits for you to pay it back over 30 years, and collects the interest. That's not what happened. Instead, the bank would bundle your mortgage together with hundreds or thousands of other mortgages. Then they'd slice this bundle into pieces called tranches. Then they'd sell those pieces to investors as securities. This process is called securitization, and it completely changed how risk worked in the financial system. Here's why it mattered. In the old system, if you defaulted on your mortgage, the bank that gave you the loan lost money. So banks were careful about who they lent to. They had skin in the game. But once banks could package loans and sell them to investors, the incentive structure flipped. The bank that originated your loan didn't care if you could pay it back. They were going to sell it within weeks anyway. Their profit came from the fees they charged for making the loan and packaging it into a security. So banks started making loans to anyone. The worse the borrower, the higher the interest rate they could charge. The higher the interest rate, the more valuable the security they could sell. It became a volume game. Make as many loans as possible, package them. Sell them, repeat. Leverage means borrowing money to make investments. If you have $1 million and you invest it, you can make or lose money on $1 million worth of assets. But if you borrow $9 million and invest $10 million, you can make or lose money on $10 million worth of assets. You're leveraged 10 to 1. By 2008, major investment banks were leveraged 30 to 1. Some were higher. That means for every $1 of their own capital, they had borrowed $30. They were controlling $30 worth of assets with $1 of actual money. Why does this matter? Because when you're leveraged 30 to 1, a 3% decline in the value of your assets wipes you out completely. Let's do the math. You have $1 million of your own money. You borrow $29 million, you buy $30 million in assets. Those assets decline in value by 3%. Now they're worth $29.1 million. but you still owe $29 million to your lenders. That leaves you with $100,000. You just lost 90% of your capital from a 3% market decline. If those assets decline by 4%, you're insolvent. You owe more than you own. This is what happened to Lehman Brothers. This is what happened to Bear Stearns. This is what almost happened to every major investment bank in the world. But it gets worse, because these banks weren't just using leverage to buy mortgage-backed securities. They were using something even more. A derivative is a financial contract whose value is based on something else. The most important derivative in the 2008 crisis was called a credit default swap, or CDS. Here's how it worked. Let's say you own a mortgage-backed security. You're worried it might default. So you buy insurance on it. That insurance contract is a CDS. You pay a small premium every month. If the security defaults, the person who sold you the CDS pays you the full value. Sounds reasonable, right? It's just insurance. But here's the twist. You didn't have to own the mortgage-backed security to buy a CDS on it. It's like buying fire insurance on your neighbor's house. You don't own the house. But if it burns down, you collect the payout. This meant people could make bets on whether mortgages would default without actually owning any mortgages. And the market for these bets became enormous. By 2008, there were over $60 trillion in CDS contracts outstanding. That's more than the entire global economy. Here's where the crisis actually started. Banks like Lehman Brothers weren't just buying mortgage-backed securities. They were selling CDS contracts on those securities. They were essentially saying, "We'll insure your mortgages. If they default, we'll pay you." They collected premiums on these contracts, easy money, free money, until mortgages actually started defaulting. When housing prices fell and defaults rose, the banks that had sold CDS protection suddenly owed billions of dollars, money they didn't have. AIG sold over $500 billion in CDS protection. When mortgages started defaulting, AIG owed money on all of those contracts at once. They didn't have it. The U.S. government had to give them $85 billion overnight just to prevent immediate collapse. But even that doesn't fully explain the scale of the crisis. Because the real mechanism that broke wasn't mortgages or leverage or derivatives individually. It was what happened when all three mechanisms collided in a system that had become completely interconnected. By 2007, the global financial system had become a web of interconnected obligations. Bank A owed money to Bank B. Bank B owed money to Bank C. Bank C had bought insurance from Bank A. Everyone owed everyone, and most of these obligations were based on the assumption that housing prices would keep rising and mortgages wouldn't default. When that assumption broke, the entire web started to unravel. Here's what actually happened. In early 2007, subprime mortgage defaults started rising. Not catastrophically, but noticeably. The securities based on these mortgages started declining in value. Banks that owned these securities had to mark down their value. This reduced their capital. But remember, these banks were leveraged 30-1. A small decline in capital meant they had to sell assets to maintain their leverage ratios. So they started selling mortgage-backed securities. When everyone tries to sell the same thing at the same time, prices collapse. As prices collapsed, more banks had to mark down their holdings, which meant more banks had to sell, which meant prices fell further. This is called a death spiral. And it was just getting started. Because now the CDS contracts kicked in. As mortgage-backed securities declined in value, CDS protection became more expensive. Banks that had sold protection had to post collateral. But they didn't have extra collateral, so they had to sell other assets to raise cash. More selling. More price declines. More margin calls. By March 2008, Bear Stearns couldn't meet its obligations. JP Morgan bought them in a fire sale for $2 per share. 6 months earlier, they'd been trading at $170. By September 2008, Lehman Brothers was in the same position. But this time there was no buyer. No government bailout. Lehman filed for bankruptcy on September 15th. And that's when the real crisis started. Because Lehman owed money to everyone. When they declared bankruptcy, every institution that had exposure to Lehman suddenly had a giant hole in their balance sheet. Nobody knew who was exposed to whom. Nobody knew who would fail next. So everyone stopped lending to everyone. The commercial paper market froze. This is where companies borrow money for daily operations. It completely stopped functioning. The repo market seized up. This is where banks borrow money overnight from each other. It vanished. Money market funds, which were supposed to be completely safe, started breaking the buck, losing value. Within 48 hours, the global financial system was on the verge of complete collapse. ATMs would have stopped working. Paychecks would have stopped clearing. The entire economy would have ground to a halt. The Federal Reserve and Treasury Department launched the largest financial intervention in history. They guaranteed money market funds. They created emergency lending facilities. They took over AIG. They injected capital into major banks. They bought $700 billion in troubled assets. It worked. Barely. But here's what you need to understand. The housing crisis didn't cause this. Housing was the trigger. But what actually broke was a financial system that had become too leveraged, too interconnected, too dependent on continuously rising asset prices, too complex for anyone to fully understand. The subprime mortgages were just the weakest link in a chain. When that link broke, the entire chain unraveled. So why does any of this matter now? Because the same mechanisms are still in place. Banks are still using leverage. The repo market is larger than ever. Derivatives markets have grown, not shrunk. The system is different in some ways. Regulations changed. Banks hold more capital. Some of the worst practices were banned. But the fundamental architecture, the leverage, the interconnection, the complexity, it's all still there. In March 2020, when COVID hit, we saw the same pattern start to play out. Asset prices started falling. Leveraged funds had to sell. Markets seized up. The Federal Reserve had to step in with trillions in emergency lending. Again. In March 2023, Silicon Valley Bank failed. Then Signature Bank. Then First Republic. Why? Because they were over-leveraged and holding assets that declined in value when interest rates rose. The same mechanism. Different trigger. This is the pattern you need to understand. The 2008 crisis wasn't a once-in-a-lifetime accident. It was the inevitable result of how the modern financial system is structured. As long as banks can operate with extreme leverage, as long as institutions are massively interconnected, as long as derivatives markets dwarf the real economy, the risk of systemic collapse remains. The trigger changes. In 2008, it was housing. In 2020, it was a pandemic. In 2023, it was interest rates. But the underlying vulnerability is always the same. Too much leverage in a highly interconnected system. So let's come back to where we started. What actually caused the 2008 financial crisis? Not subprime mortgages, not greedy bankers, not a housing bubble. What caused the crisis was a financial system that had been built on three unstable pillars. 1. Securitization, that divorced risk from responsibility. 2. Leverage that amplified small losses into catastrophic failures. 3. Interconnection that turned individual failures into systemic collapse. When housing prices fell, these three mechanisms fed on each other in a death spiral that nearly destroyed the global economy. The common narrative, that it was all about subprime mortgages, misses the real story. The real story is about the architecture of the financial system itself, and that architecture is still largely intact. Understanding what actually broke in 2008 isn't just about history. It's about recognizing the patterns that could trigger the next crisis. Because the question isn't whether another crisis will happen. The question is what will trigger it, and whether we'll recognize the warning signs in time. Now you know what to look for.